Stop whatever you are doing and focus carefully, because what just unfolded in the silver market is not routine, not ordinary, and not something you can casually dismiss as another volatile trading session. Today, silver delivered a move that does not happen in normal cycles, does not happen during stable periods, and does not happen without something far deeper shifting beneath the surface. This was not a random spike. This was not speculative noise. This was an event that historically appears maybe once in several decades, and when moments like this arrive, they tend to separate those who understand structural change from those who react emotionally after it is too late. Silver surged nearly 8% in a single session. 8%. That is not a rounding error. That is not exaggeration. That is a violent repricing of an asset that has spent years frustrating participants with choppy sideways action and sudden breakdowns. And now, suddenly, it has erupted higher with a force that even seasoned traders did not fully anticipate. Price is now trading in the $93 to $94 range. Triple-digit silver, a concept that felt distant not long ago, is now within striking distance. But the price itself is not the most important part of this story. The structure underneath the price is where the real signal lives, and that structure is flashing warnings that something fundamental inside the market framework may have cracked. This moment is different from previous rallies because it is not being driven by a single headline or a temporary burst of enthusiasm. It is being powered by three separate forces converging at once, and when those forces align, they create pressure that gold alone cannot replicate. The first engine is geopolitical acceleration. You are already aware of the escalating joint military operations involving the United States and Israel targeting Iran. Operations carrying dramatic names like Epic Fury and Roaring Lion may sound theatrical, but their consequences are tangible and severe. Reports describe strikes on Tehran, the reported death of Iran's supreme leader, and conflict activity spreading across 8 countries. The Strait of Hormuz faces the possibility of blockade, threatening global energy flows. These developments inject fear into financial systems rapidly, yet what stands out is not simply that silver rose. It is how aggressively it rose relative to gold. Gold advanced roughly 2%, while silver surged 8%. That is 4 times the performance. A 4-to-1 outperformance ratio during crisis conditions reveals a powerful shift in preference. Silver is behaving as a high beta safe haven. In periods of heightened fear, it amplifies capital inflows more intensely than gold. Investors are not merely seeking stability. They are pursuing upside leverage within the safe haven category. Capital is rotating out of equities, away from the dollar, and into precious metals. Within that rotation, silver is being chosen over gold because participants perceive larger potential gains if instability persists. That preference is now visible in price behavior. The second engine driving this move is structural stress inside the futures market, and this is where the story becomes more serious. The futures exchange where silver contracts trade operates primarily as a paper marketplace. Contracts representing silver are bought and sold constantly, and most are settled in cash. Physical metal rarely changes hands. This system functions efficiently as long as participants are comfortable accepting cash settlement. However, the integrity of a paper market depends on confidence. If too many participants demand actual delivery of physical metal instead of cash settlement, stress begins to surface. Recent developments indicate that this stress is no longer theoretical. A reported sell order of 159 million ounces triggered a trading halt on the exchange. That number requires context. The registered inventory available for delivery sits under 60 million ounces. The sell order exceeded available physical inventory by more than 2.5 times. This illustrates a widening disconnect between paper claims and physical supply. For years, sophisticated analysts have warned about this imbalance. Paper contracts can be issued in large volumes, creating the appearance of ample supply. But when delivery is requested, physical availability imposes limits. With the first notice day approaching, the point when futures contracts can convert into delivery demands, the physical silver market is reportedly tighter than it has been in more than 50 years. That level of tightness signals vulnerability. When paper exposure dramatically exceeds deliverable inventory, the system becomes sensitive to shifts in confidence. This environment is why some analysts describe the current phase as a developing silver squeeze entering a parabolic stage. It is not driven solely by fear or investment speculation. It is fueled by a structural mismatch between contractual obligations and tangible supply. When that mismatch grows too wide, price volatility escalates rapidly because the market must reconcile expectations with physical constraints. If participants increasingly choose physical delivery, pressure intensifies. And pressure, when concentrated in a leveraged system, does not dissipate quietly. The third engine involves institutional reassessment. Major financial institutions are revising their outlooks for silver in ways that would have sounded extreme not long ago. Deutsche Bank has highlighted that the current gold-to-silver ratio around 57 suggests substantial upside risk to its $100 projection. The ratio measures how many ounces of silver equal 1 ounce of gold. Historically, that relationship has fluctuated between 40 and 60. When the ratio sits near the higher end, silver is considered undervalued relative to gold. With gold trading above $5,000 and silver near 94, the ratio remains elevated, but not historically extreme. However, if gold continues climbing and the ratio compresses toward historical norms, silver must rise substantially to maintain that equilibrium. For example, if gold reaches $6,000 and the ratio tightens to 40, silver would need to approach $150. If compression extends toward 30, levels seen during prior bull markets, silver could exceed $200 while simply preserving relative balance. Billionaire investor Eric Sprott has also warned that sustained physical supply depletion could ultimately force a revaluation shock targeting $300. That figure appears dramatic, yet it emerges from arithmetic rather than fantasy when supply deficits and ratio compression are considered simultaneously. None of these projections guarantee outcome. Price paths are rarely linear. Volatility remains unavoidable. The technical landscape reflects this tension. On shorter time frames, silver has broken out of an ascending channel and reclaimed 91 as support. Holding above that threshold preserves bullish momentum. Immediate resistance sits near 95, representing the final psychological barrier before triple digits. Momentum indicators approach overbought territory, suggesting potential sharp swings and stop-loss hunts. Overbought conditions do not mandate reversal, but they imply elevated risk of sudden pullbacks before continuation. Overlaying all of this is a persistent global deficit of approximately 67 million ounces annually, meaning demand exceeds newly mined supply by that amount each year. The gap is filled through drawdowns of existing inventories, yet inventories are finite. Structural deficits do not resolve indefinitely without price adjustment. Geopolitical shocks may accelerate moves, but long-term supply imbalance forms the foundation beneath them. Today's surge is therefore not a simple rally. It is the convergence of geopolitical fear, structural strain in paper markets, institutional reevaluation, and a persistent physical deficit. When multiple engines ignite simultaneously, the resulting momentum can reshape expectations rapidly. Whether this marks the beginning of sustained repricing or a volatile chapter within a longer consolidation depends on how these forces evolve. But the signals flashing across price action, future structure, and institutional forecasts suggest that silver has entered a phase that demands serious attention rather than casual observation. Understanding what is unfolding right now requires stepping back from the excitement of a single explosive session and examining the mechanics that could determine what happens next. Price spikes capture attention, but structure determines durability. When silver moves nearly 8% in one session and pushes into the $93 to $94 range, the immediate reaction is emotional. Some feel urgency to chase, others fear a reversal. Yet the more important question is whether the underlying conditions support continuation or whether this was a temporary surge fueled by headlines. The answer lies in liquidity, leverage, positioning, and the tension between paper exposure and physical availability. The futures exchange remains central to this story. Contracts representing millions of ounces trade constantly, creating enormous notional exposure compared to the metal that actually sits in vaults. Most of the time, that imbalance remains theoretical because participants settle in cash, but markets operate on confidence. If a sufficient number of contract holders request delivery rather than cash settlement, the exchange must supply metal. When available registered inventory sits below 60 million ounces, while paper exposure stretches multiples above that figure, stress builds quietly. The reported 159 million ounce sell order that triggered a trading halt was not merely large. It symbolized how thin the margin between perception and reality has become. A paper system functions smoothly until participants begin testing its physical limits. Once that testing accelerates, volatility follows. As the notice period approaches, the potential for conversion of futures into delivery demands increases sensitivity. Even if only a fraction of outstanding contracts request metal, the scale relative to available inventory matters. A system with abundant supply absorbs demand comfortably. A system with constrained supply reacts sharply. This is why analysts describe the present environment as a developing liquidity trap. If too many participants simultaneously choose delivery, the exchange must either source additional metal, incentivize cash settlement, or face pricing dislocations. None of those outcomes occur quietly. They occur with price repricing. Layered onto structural stress is technical positioning. On the 4-hour chart, silver has broken decisively out of an ascending channel and flipped the $91 level into support. That threshold is not arbitrary. It represents the line separating continuation from potential breakdown. As long as daily closes remain above 91, bullish structure holds. A decisive break beneath that level complicates the picture and invites deeper retracement. Above current price, 95 represents immediate resistance. Clearing 95 with conviction opens psychological space toward triple digits. Psychological barriers matter because they shape order flow. Traders cluster stop orders around round numbers, and once breached, those clusters can accelerate movement. Momentum indicators provide caution. The relative strength index is hovering near 70, signaling overbought conditions. Overbought does not equal imminent collapse. Strong trends often remain extended for prolonged periods. However, elevated momentum increases probability of sharp intraday swings designed to shake out weak positions. Stop hunting wicks become common in these phases. Sudden downward spikes may appear without warning, only to reverse quickly. Those without risk discipline often exit at precisely the wrong moment. The coming session introduces two plausible scenarios. If geopolitical tensions intensify and headlines deteriorate, the market could open with a gap higher and continue advancing. Gap and run behavior leaves late entrants scrambling. On the other hand, any signal of diplomatic de-escalation could trigger a rapid retracement toward 91, filling the gap and resetting momentum. Silver has a long history of bull traps, where enthusiasm peaks just before a pullback. Both outcomes remain possible because the drivers are fluid. Beyond short-term volatility, the 67 million ounce annual deficit remains the most persistent variable. Global demand for silver exceeds global production by that amount each year. Industrial consumption tied to electronics, solar panels, and emerging technologies adds to investment demand. The shortfall is satisfied through inventory drawdowns. Vault stocks, exchange-traded products, and historical reserves supply the difference. Yet inventories are not infinite. Each year of deficit reduces buffer capacity. When buffer capacity shrinks sufficiently, price must adjust to ration demand or incentivize additional supply. Mining output cannot expand overnight. Exploration, permitting, and development take years. Structural deficits therefore exert slow but cumulative pressure. Institutional commentary reinforces this perspective. When Deutsche Bank references the gold-to-silver ratio around 57 as presenting upside risk to a $100 forecast, it signals reassessment. Historically, ratio compression accompanies silver bull phases. If gold sustains levels above 5,000 and advances towards 6,000, and the ratio contracts toward 40, arithmetic alone implies silver near 150. A deeper contraction toward 30, observed during prior bull markets, would imply levels exceeding 200. Eric Sprott's projection of a potential revaluation shock toward 300 rests on sustained physical supply drain rather than speculation alone. Extreme outcomes emerge when structural imbalances persist long enough. However, projection does not equal inevitability. Markets rarely travel in straight lines. Even within powerful bull markets, drawdowns of 20 to 30% occur regularly. Those unprepared for volatility often exit before the thesis plays out. Risk management therefore becomes central. Position sizing should reflect tolerance for substantial retracements. Leverage amplifies both gains and losses. When silver moves 8% in one direction, it can just as easily move 8% in the other. Exchanges can adjust margin requirements abruptly, forcing liquidations. Participants who overextend risk being removed from positions precisely when volatility peaks. An intellectually honest framework also acknowledges failure scenarios. A coordinated de-escalation in geopolitical conflict, combined with hawkish monetary signals and a strengthening dollar, could drain momentum. If 95 rejects price decisively and support at 91 fails, silver could revisit lower levels near 80. Such a move would not necessarily invalidate long-term structural deficits, but it would punish short-term momentum chasers. Being correct about long-term direction does not protect against short-term mismanagement. The emotional component of markets cannot be ignored. Euphoria emerges quickly during rapid advances. Fear dominates during retracements. Successful participants learn to observe their own reactions as indicators. When urgency to chase becomes overwhelming, risk often increases. When pessimism becomes extreme, opportunity frequently appears. Discipline separates those who endure from those who react impulsively. Physical market indicators deserve monitoring alongside price charts. Premiums above spot for physical bullion reveal stress between paper and tangible supply. Rising lease rates for borrowing silver signal tightening availability. Delivery statistics from the futures exchange illustrate whether participants are opting for metal or cash. Divergence between paper pricing and physical premiums may precede larger repricing events. Today's surge must therefore be interpreted within a multi-layered framework. Geopolitical tension ignited safe haven demand. Futures market structure amplified sensitivity due to limited deliverable inventory. Institutional reassessment adjusted long-term expectations. A persistent global deficit underpins the entire narrative. Technical breakout confirmed momentum, but introduced overbought conditions. Each layer interacts with the others. Whether this phase evolves into sustained parabolic expansion or pauses for consolidation depends on how these engines continue firing. If geopolitical risk remains elevated, if physical delivery demand increases, and if institutional capital continues reallocating towards silver, upward pressure intensifies. If tensions ease and speculative positioning unwinds, retracement follows. The path forward remains uncertain, but the structural variables now command more attention than at any time in recent memory. In environments like this, preparation matters more than prediction. A plan for both continuation and pullback reduces emotional decision-making. Monitoring support at 91 and resistance at 95 provides objective reference points. Observing physical market signals clarifies whether structural strain persists. Managing leverage conservatively preserves staying power. The opportunity presented by this alignment of factors is significant, yet the risks are equally real. Silver has entered a phase where discipline will determine outcome more than enthusiasm. The coming sessions will test not only the metal's resilience, but also the resolve of those participating in it. Step back and look at the broader landscape, because what is happening in silver is not occurring in isolation. It is unfolding within a global financial system already stretched by geopolitical instability, structural supply shortages, monetary uncertainty, and fragile confidence in paper promises. When multiple fault lines begin shifting simultaneously, certain assets become pressure gauges. Silver has now stepped into that role. It is no longer moving quietly in the background of the precious metals complex. It is reacting loudly, aggressively, and in a way that suggests deeper forces are aligning beneath the surface. Today, silver is acting as a financial barometer for instability. When global tension escalates, capital seeks refuge. Traditionally, that refuge has been gold, but this time silver is not simply following gold. It is amplifying gold's movement. That amplification signals something different from a routine safe haven rotation. It reflects investors searching for asymmetric upside in a world where uncertainty feels persistent rather than temporary. When fear lingers, participants begin positioning not just for protection but for repricing. The geopolitical environment remains fluid. Military operations involving the United States and Israel targeting Iran, reported strikes on Tehran, the death of Iran's supreme leader, and activity spreading across 8 countries introduce volatility into energy markets and global trade routes. The Strait of Hormuz facing potential blockade adds another layer of risk. Energy disruptions ripple across inflation expectations, currency stability, and equity markets. Silver benefits in such scenarios not only as a safe haven asset, but also as an industrial input sensitive to growth expectations. That dual identity magnifies its reaction. At the same time, the structural imbalance between paper contracts and physical inventory has not disappeared. The reported 159 million ounce sell order that halted trading exposed how thin deliverable supply can appear relative to outstanding exposure. With registered inventory under 60 million ounces, the scale of contractual claims dwarfs available metal. This mismatch does not guarantee collapse, but it introduces fragility. Systems operating with limited buffers react violently when stressed. As the notice period approaches and the potential for delivery requests increases, confidence becomes central. If participants remain content with cash settlement, stability persists. If confidence wavers and delivery demand accelerates, repricing intensifies. Overlaying structural stress is the persistent 67 million ounce annual deficit. Global consumption continues exceeding production by that margin. Industrial demand from solar expansion, electronics, and emerging technologies intersects with investment demand from institutions and individuals. Each year, inventories shrink to bridge the gap. While stockpiles accumulated over decades provide cushion, drawdowns cannot continue indefinitely without consequence. Eventually, price must ration demand or incentivize supply. Mining expansion is slow, capital-intensive, and constrained by permitting and environmental hurdles. The deficit therefore acts as a slow-burning fuse beneath market dynamics. Institutional projections reinforce the magnitude of potential repricing. The gold-to-silver ratio around 57 implies that silver remains historically inexpensive relative to gold. If gold sustains levels above 5,000 and trends higher, ratio compression toward 40 suggests silver near 150. A contraction toward 30, observed in prior bull phases, suggests levels exceeding 200. Eric Sprott's discussion of a possible revaluation shock toward 300 arises from cumulative deficit pressure combined with potential physical shortages. These numbers are not guarantees, they are outcomes derived from mathematical relationships under specific assumptions. But the fact that major institutions and experienced investors discuss such targets indicates a shift in perception. Yet discipline requires acknowledging uncertainty. Markets punish complacency. A coordinated de-escalation of geopolitical conflict combined with restrictive monetary policy and a strengthening dollar could cool enthusiasm. If price fails to hold above 91 and encounters repeated rejection at 95, consolidation or deeper correction becomes plausible. A retreat toward 80 would feel dramatic but would not erase structural deficits. Long-term narratives often survive short-term volatility. However, those overextended with leverage may not survive the swings. Risk management therefore becomes the central theme in this phase. Silver's history includes explosive advances followed by abrupt pullbacks. 8% rallies generate excitement, but equivalent declines occur just as quickly. Leverage magnifies exposure. Exchanges can adjust margin requirements without warning. Forced liquidations cascade through markets, accelerating moves beyond rational valuation. Participants who size positions modestly and maintain liquidity retain flexibility. Those who overcommit risk becoming casualties of volatility rather than beneficiaries of trend. Technical levels provide objective anchors amid emotional turbulence. The reclaimed $91 support represents structural stability. Sustained closes above it preserve bullish formation. A decisive break beneath it signals caution. Resistance at 95 stands as the final psychological barrier before triple digits. A clean breakout accompanied by volume would confirm continuation. Failure at that level invites retracement. Momentum indicators near overbought territory caution against assuming linear advance. Strong trends can persist, but they often test conviction through sharp countermoves. Beyond charts and ratios lies psychology. When narratives of $300 silver circulate widely, euphoria can distort judgment. When retracements shake confidence, fear can distort judgment just as severely. Successful participation requires detachment from extremes. Owning silver, without understanding the thesis, invites panic during drawdowns. Owning it with conviction based on structural analysis allows endurance through volatility. Emotional awareness becomes a strategic tool rather than a weakness. Physical market signals should remain under close observation. Rising premiums for bullion over spot price indicate tightening supply. Increased lease rates reflect scarcity in lending markets. Delivery statistics reveal whether futures participants prefer metal or cash. Divergence between paper price stability and rising physical premiums may foreshadow stress. Conversely, normalization of premiums during pullbacks may signal cooling demand. Today's environment represents convergence. Geopolitical escalation fuels safe haven flows. Structural futures market imbalance introduces fragility. Persistent annual deficit underpins long-term scarcity. Institutional ratio analysis projects potential repricing. Technical breakout confirms momentum. Each component alone might not produce sustained parabolic advance. Together, they create conditions where rapid adjustment becomes plausible. Still, humility remains essential. No market outcome is guaranteed. Extraordinary setups can fail. Historical opportunities have rewarded the disciplined and punished the reckless. Preparing for both upside expansion and downside correction preserves resilience. Monitoring support and resistance provides structure. Managing leverage conservatively protects longevity. Remaining informed about geopolitical developments prevents surprise. Silver has transitioned from a dormant asset into a focal point of global financial tension. Its movement today was not casual noise. It was a signal that forces long discussed are now interacting simultaneously. Whether this interaction produces sustained generational repricing or a volatile chapter within a broader cycle depends on developments that remain uncertain. What is certain is that complacency is no longer appropriate. The metal has entered a phase demanding attention, analysis, and discipline. As volatility intensifies, clarity of purpose becomes the differentiator. Understand why exposure exists. Accept that drawdowns are part of the journey. Avoid decisions driven purely by fear of missing out or fear of loss. The coming sessions and weeks may test patience, conviction, and strategy. But moments of structural alignment such as this rarely pass quietly. Silver has issued a statement. The response from participants will determine whether this phase becomes opportunity realized or lesson learned.